the house. And I said, why did you come here? Why aren't you going?
I'd like to call the May 11, 2018 meeting of the SDCERS Board of Administration to order.
Is your mic on?
No. Try that again. So I'd like to call the meeting to order this morning, May 11th, 2018. And I believe we have a quorum.
We have a quorum.
We have a quorum. So the first item on our agenda this morning is non-agenda public comment.
No public comment.
There is no public comment, so we move on to the approval of consent agenda items A through D. Does anyone wish to discuss any of those items before we vote on the slate? Hearing none. Is this a motion that I make without a second, or
Need a second.
we do need a second? Okay. So I've made the motion. Bill Hayner has seconded the motion.
Ready to vote?
And that motion carries 12-0. That brings us to the Audit Committee. Chair Greg Koyeski, but I believe Bobby Spoon is going to present today on behalf of the Audit Committee.
And I believe, we're going to some closed session?
We're, part of the Audit Committee report will be addressed in closed session at the end of the meeting, so we'll skip over that. Yeah, and so we'll just go into the open session part, and then when we have closed session at the end, Bobby will come back and address the closed session issues.
Do we want to pick the new one?
The audit committee met and interviewed three applicants for the internal auditor position. And thank you.
You bet.
The audit committee met, interviewed three applicants for the audit committee, or for the internal audit position. They were all excellent candidates, absolutely excellent candidates. We were so pleased with the selection that we had that it made it exceptionally difficult. The search committee interviewed, I believe it was 8, and then they brought 3 to us. So we have made our decision. I believe we need to discuss that in closed session, is that correct?
Correct.
And then
Okay,
in following closed session, we'll come back to this item to talk about the process.
all right, that's good.
Do we want to talk about the delegation of authority at this stage, or you want to wait for closed session for that?
Is there a motion?
We do?
Do you want to do it right now, Val?
I think we should go ahead and address those issues now, and then come back and talk about the candidates in closed session, but that's only because that's what Greg suggested to me before the meeting.
That's fine.
If you would prefer to do it all later, we can.
No, why don't, let's
All
do
right.
this now. So that the audit committee recommends to this board to delegate the board's authority to the audit committee to hire the chief internal auditor, and delegate that authority to me. I am the only board member that sits on the audit committee, to select the final candidate, to make a conditional offer of employment contingent upon the medical and background checks, to set the salary in the range of from $125,000 not to exceed the municipal code salary maximum of $151,840 per year, to set the hire date, and to provide for as needed relocation costs not to exceed $5,000. So that the audit committee would like to bring that motion forward to the board.
Terrific. So this is a delegation of authority to move forward with the hiring of a candidate, and we will discuss the candidates in closed session at the end of the meeting.
Correct.
All right. Does anyone wish to weigh in on this before we vote? So having made the motion as the chair of the committee, do we require a second?
No.
We do not require a second. So Bobby, if you would push the button.
Ready to vote? All votes are in.
And that's a 12-0 vote. So the authority has been delegated. We'll address the rest of this in closed session. And I think with that, we conclude the audit committee report for now.
Right.
Great. Then we move on to business operations. The first item on that is the election of a new board president, and you'll notice I said new. And so I'll turn the podium over to Greg.
Good morning. It's a pleasure to see everyone this morning. Per our board charters, we are required at this meeting to address the election of a president. The rules allow us to elect a sitting president for a second term, or if there's no sitting president, we can elect a nominating committee. As this is
Even if there is a sitting president eligible for a second term, we can elect a nominating committee.
That's correct. President Hoy has served 1 year as president, so he's eligible to serve the board for an additional year as president. So at this time, it would be appropriate to either have a motion to elect President Hoy for an additional term or to appoint a nominating committee.
I move to elect President Boy for a second term because I don't think he should be allowed off that easily. So that's my thought on that. So,
And I think you're right.
I'll second.
They're gonna vote.
when you write the motion, just go ahead and make me sound more important and impressive than I was, okay? Thank you. I am usually fiction.
Thanasi, can you enter your motion?
the
Bobby,
button
did
comes
you want
up,
to
I
second
can.
it with your button?
Okay.
Ready to vote? All votes are in.
Congratulations, President Hoy.
Try to screw things up this term, okay?
Thank you all. It has been an honor and a pleasure to do this for 1 year, and hopefully it will be a good second year as well. And I think with the staff that we have and the wonderful board members that I serve with, that's almost a certainty. So I want to thank all of you. It's really nice working with this group. And I know that it hasn't always been that way on this board. Years before I was here, it was a very contentious board. But right now, it's a solid board with really good, different perspectives. And I was actually just talking to Carol before the meeting. She had an experience in the investment committee meeting that I also had in the disability committee meeting where a motion came up, and due to the discussion of the committee, we completely changed course on what we would have thought we were going to do because there were so many good ideas pointed out, and everybody started to focus on the right things. And this board has been really special in its ability to do that on any number of issues. And so I'm very proud of this board. And of course, we couldn't do what we do without an excellent staff, which makes it easy for us. So thank you all. With that, we move on to the Disability Committee and a report out from Charlie Hogquist.
Good morning. Disability Committee met yesterday. We had several routine applications for disability retirement that the committee has recommended be approved. We also had one issue concerning a denial of, or I should say a continuance of the time period for somebody to file, which is also being considered. And lastly, we did have an item that we moved to closed session concerning an investigation of a claimant. And in addition to that, I just gave everybody some information. Back in January, I had asked Johnny Tran to get us some information about the number of people who applied for disability retirements that were denied and then were no longer rehired by the city. And according from the fiscal year 2010 to fiscal year 2017, we processed a total of 200 disability applications. 67 of those were denied. Of the 67, all but 4 people were eventually terminated, but not for reasons for the medical. But we have not been able to determine what those other 4 terminations were for. So it's one of those things that it doesn't seem to be as big a problem as perceived, but it is something to be on our radar to look for, to see what happens if any other future issues like this do come forward. And I wanted to thank Johnny again and the staff for the great work they did getting that.
Thank you, Charlie. Something happened yesterday that has never happened in my tenure on the board, which is the disability meeting took longer than the Business and Governance Committee meeting, and was more full of discussion. It was a very good meeting. But that leads me next to Business and Governance report out by Thanasi.
Val,
Oh, we have the action items to approve. Sorry
Yes.
about that. 1 through 4. We didn't do 5. We pulled 5, right?
Correct, 5 is pulled.
All right. Charlie makes the motion. I noticed this motion-making process has slowed down a little bit. I don't know if there's a technological issue or. There we go.
Ready to vote?
You're not even present for an hour and you're already complaining?
This was yesterday, too. The vote buttons were.
Almost.
Charlie, you want to report that out?
Yes. I'm just waiting for the,
It's slow.
The summary to
It's
come up.
slow today. I don't.
okay. The motion passes 13-0.
None of us are paying attention.
Great. All right, now I think we move on to,
Excuse me, Mr. Hoy, we still have one more item, C1, under disability.
That's right.
all right, so, sorry about that. I'm forgetting things today. Disability-related administration action item, which was approved. So can we pull that up? All right, and this was a staff's recommendation, which was approved by the committee to waive Board Rule 7.180A in order to allow Booker Bowen to disability retire effective March 13, 2018. Mr. Bowen inadvertently worked an extra day.
Correct.
He had officially retired, but he came into work due to a confusion about what his retirement date was, and so this is to correct the record on that.
I have a question about that, and I apologize for not being able to make disability yesterday. Have we ever done this sort of move before? We wavered
We
for
asked
this
that.
sort of correction?
Nobody's ever inadvertently worked before.
No one had ever done this before.
And then, no. And is this the correct Robert Rules way of doing things to waiver or should we vote to?
Well, I think, Charlie, you can address this as
Yes.
committee chair.
What happened was this is just basically a cleanup move that's within the board policy and the rules. And apparently our employee never got the message that, hey, you're retired on Friday, so he showed up to come to work on Monday. And once he comes to work, he's still working. So you have to change his retirement date, or else it screws up all of the calculations.
No, I understand that. I just never seen
Legal-
waiver of a board rule as being on this board before. And
It's a
that caught my
question that
attention.
I asked yesterday as well. And legal gave us the opinion that this was a permissible waiver. And the committee felt that given that his issue was he'd worked an extra day, that it made a lot of sense to just correct the record.
Okay.
But we did get that opinion. All right.
Okay, it's been moved and seconded. Please vote.
All votes are in.
Okay, and the motion passes 13-0.
All right. I think I'm out of disability now.
Yes.
Mr. Priovalos.
Well, thank you. The Business and Governance Committee met yesterday. We had a very long and laborious meeting with a great deal of discussion and homework. I think of the items that were covered, I feel compelled to just explain that Mr. Gonzalo Lopez, this is item number 2, came yesterday and pitched his rationale for the appeal, and I want the board to know that Mr. Gonzalez did a couple things that were interesting. Mr. Lopez, I apologize, did a couple of things. Number one, he paid his bill in full and then appealed, and we did thank him for that. Number two, I think he was unaware of the precedent of the board, and he was unaware of the municipal code rules as to why we had voted the way we had and why his appeal was denied. He was very articulate, and I think he was very logical in his request. I think he represented himself extremely well, and I think, quite frankly, probably most of the committee members would love to have granted him his relief, but due to the interesting situation that we are in between the IRS, our plan sponsor, and the municipal code, we had to deny the appeal. I call that the Bermuda Triangle where we sit as a board. So I did want to point that out, and I wanted to thank him publicly because I think he did a great job coming in and expressing his opinion. So I wanted to report that out. Everything else was, I think the staff did a great job of producing their reports. I'm sure you all read them as the committee members did. There really was no need for a lot of discussion because the reports were well written, although Ted had to cry about the fact that I didn't comment on his new graphics in his report, and I feel bad. I should have done it. So Ted, officially, I want to thank you for the new graphics in your report. They were phenomenal, and I would ask my committee members to join me in a round of applause for Ted. Thank you, Ted. I appreciate that. So with that, and since now my speech is longer than our meeting lasted yesterday, I'd like to move on the consent agenda for the 10 action items. It's not slow for me, by the way, Val. I saw it right away.
Ready to vote?
Slow from me.
All right, you got it. All votes are in.
And that motion passes 13-0. Thank you.
Is that it?
We just had, the rest of them were just reports, unless anybody has any questions or comments on the committee. There's no other action items.
Thank you, Tanasi. That brings us to the Investment Committee. Carol Broad.
Good morning. We also had a interesting and robust meeting yesterday. It actually was long, and we did do a lot of work. And we have quite a few action items. I think we're prepared to go through them pretty quickly. The first one, Jamie and Demetrios are going to lead us through, is this selection of a custodial bank.
Thank you. State Street was initially hired by SDCERS in 1998. In 2007 and 2013, SDCERS issued RFPs for custodial banks, and both times chose to retain the services of State Street. Because State Street's current contract is up in September, this necessitated the issuance of the current RFP. The search process was initiated in October of 2017, led by the investment consultant Aon. On December 13th, a detailed questionnaire that was specifically customized to SDCERS' service requirements was sent out to candidates. And on January 8th, SDCERS received responses from 3 banks: State Street, Bank of New York Mellon, and Northern Trust. Over the course of this search, staff and the consultant conducted a comprehensive review of these banks, the scope of their services, and their competitive advantages. This included presentations at SDCERS' offices in the middle of February and due diligence visits to the offices of each of the 3 banks at the end of March. After evaluating the services and capabilities of each bank, staff and the consultant have formulated the following recommendation. And now I'll turn it over to Jamie to give that recommendation and provide some reasoning behind it.
Thank you. Staff and the consultant are recommending the selection of State Street as custodial bank for SDCERS. The proposed contract will be for a term of 5 years with the option for 2 one-year extensions. There are 3 main reasons for SDCERS to continue its relationship with State Street. The first reason is State Street's commitment to improving their core services. By keeping an open line of communication, SDCERS and State Street are aware of all issues and concerns that both organizations have. State Street continually is looking for solutions and tools to ensure that SDCERS assets and the reporting of those assets is correct and efficiently done. The second reason is that SDCERS relationship is serviced out of the Sacramento office, which also services some of the largest California public pension plans. This office provides a distinct advantage over its competitors in that we share the same time zone, which allows for better resolution of questions and issues that arise. In addition, the client service team assigned to SDCERS has provided strong customer service to SDCERS throughout the course of its relationship. The third reason is State Street's ongoing focus on technology. State Street has embarked upon a technology initiative to improve its online portal system called My State Street, which clients use to access their data at the bank. State Street is currently 2.5 years into this project and have made a number of improvements to the system. In the remainder of the project, State Street will continue to make improvements to streamline the online portal to enhance the client's experience. Finally, I'd like to point out that SDCERS will be subscribing to a new service in this contract for alternative asset services. In this service, State Street will have a dedicated team that will review all capital call and distribution notices that take place within real estate, private equity, and infrastructure. That team will enter all capital calls into the electronic cash management system for SDCERS approval, as well as enter all of the detailed accounting on a daily basis. This is different from the current process, where all of this transaction activity is derived from capital call, distribution notices, and quarterly statements from the investment managers on a monthly basis. A subscription to this service will allow SDCERS to have better data at State Street in a timelier manner. Staff had budgeted for the addition of this service in the fiscal 2019 budget, and the final amount that State Street will charge will be less than that original proposed amount that we budgeted for. And with that, we'd be happy to answer any questions that you have about the process or State Street services that they've provided to SDCERS.
Tanasi's in the queue.
I just wanted to say that, Dimitri, I do think the beard makes you look older and wiser, but I recommend stroking it when you are asking questions or making a presentation. That's just my 2 cents. Thank you.
Order. I have an actual question.
Yes.
Wow, it's amazing.
When we enter into this kind of an engagement, and you say it's a 5-year term with 2 one-year options, I assume the options are in our favor, but it sounds more like a lease or something to me. Are we unable to make a change can we change this at will at any time?
Absolutely.
So
There's a 30-day termination clause. Originally, I would say, in prior contracts, we had the 5-year term with 2 one-year extensions to provide some stability in your fees.
Okay.
In this case, we were able to negotiate to lock in the fees for the full 7 years. So the flat fee that they charge us.
So the reason for the term is to lock in certain financial terms for our benefit or theirs. I mean, they're
Right.
making fees, but
I mean, also to provide some additional flexibility. If we were unhappy with our relationship, we could embark upon an RFP process and get out sooner. But if there was an emergency and we really needed to get out, we could do a 30-day termination clause. It does take 4 to 8 weeks to transition to a new bank. So that's just something to keep in mind.
thank you.
Actually, one thing that came up yesterday was the possibility that fees will come down in this space due to technology in the future. And so my understanding was the way the contract works protects us to be able to
To take
realize lower
advantage of
fees
any savings.
if that's the case,
If
right?
their
Right.
current market fee is lower than the SDCERS fee, we certainly will go back and renegotiate and
Right.
try to obtain that fee.
Okay, Almas is in the queue.
Thanks. How did the overall cost compare, again, among the 3 competitors?
Great question. So let me talk about State Street first, and then I can get to the other 2 competitors. With the current services that SDCERS has, it's a decrease of 3.2% from the proposed to their current. With the new service that we're adding, it does result in an increase overall of 6.7%. But looking at the other competitors, they're certainly within reason. The other 2 are slightly lower than State Street, and that is primarily because they want the business.
But if I understand it correctly, their State Street's technology and customer experience are superior to the other 2 competitors. Is that correct?
Yeah, that is correct.
Thank you.
Any further questions? Oh, Bill, go ahead.
Not a question. I just want to say staff did a great job here. These 3 banks that we looked at, Northern Trust, Bank of New York, Mellon, and State Street, are outstanding, all three of them. The one thing that concerned me a little is that State Street, 89% of State Street's revenue comes from their custodial business. And it's so technology-driven today that all this cyber stuff going on, that if things happen, it may happen to everybody, but if it happened to one bank, it'd be pretty disastrous.
Absolutely, that is certainly a concern to have. But the thing to keep in mind about State Street is they do have other lines of business. They have their State Street Global Markets, which encompasses their transition and their securities lending business. They have State Street Global Advisors, which is their investment management arm. And then they have the division that's currently building out, which is their data analytics group. And that's where all the technological advances that Carol was referencing, that's where they're building those in an incubator.
Thank you.
Okay, I think we're ready to vote. I will make the motion. And I don't need a second.
Ready to vote? All votes are in.
And that is approved 13 to 0. Thank you. Okay, our next action item is review and recommendation regarding SDCERS rebalancing model. This is something that we do periodically. Anders is going to present this. We also benefited from analysis done by an advisory team at Allianz, which is one of our managers. But they have an advisory team that brought in some really smart people who helped do some sophisticated analysis on this, and that I understand is a service that they provide to clients for free.
Yeah, that's a solutions team. That's all they do, basically.
Yeah.
So we use that from time to time when we get a chance. So SDCERS reviews the rebalancing model every 3 to 5 years, and last time we reviewed it was in 2014, when BlackRock and Parametric independently reviewed the rebalancing model and came up with no changes at that time. And as Carol mentioned, this time we asked Allianz to look at our rebalancing model and analyze it and see if there was any better way to go about doing what we do when we rebalance. So,
Anders, could I stop you for 1 second?
Yep.
For those of us who don't serve on the investment committee, would you just briefly describe what a rebalancing model is?
Absolutely. Good point. So when we have a portfolio of multiple different asset classes, those asset classes go up and down with market values. So let's say, for example, you have a portfolio that's 60% stocks and 40% bonds. Stock market goes up like it's been doing the last 5 or 6 years. Then you're going to end up eventually in maybe a 70-30 portfolio that you're not intended to be in. So what you want to do is you want to rebalance that portfolio to bring the assets back down, equities back down to 60, and then you need to buy fixed income or bonds to bring that back up to 40 again. So that kind of goes back to the whole philosophy of buy low, sell high. So you're selling assets that have gone up a lot in value, and you're buying assets that are that have gone down in value. Kind of goes back to the whole concept of mean reversion.
It's a kind of a discipline.
Exactly. So the two factors that we're thinking about when we're talking about rebalancing model is also transaction cost is very important, and tracking error is very important. The tracking error is basically you're looking at your asset allocation, and what we're talking about drift from the asset allocation. The returns of the portfolio will differ from your benchmark returns the further out you go from these ranges. So that's why the rebalancing model keeps us disciplined and makes us sell assets that have gone up and buy assets that have gone down in value. Does that make sense to everyone? Okay, good. So let's see here. Get this. Control R? Control R or L? All right, thanks. Let's see here. There we go. There we go. Sorry about that. And let's see. So When you're looking at the best way to rebalance, we have to take consideration, as I told you, about the two factors, transaction cost and tracking error. And tracking error increases the more you deviate from your original allocation. So if you rebalance too frequently, you will incur a lot of transactions cost because you're buying and selling a lot, which you're trying to avoid because transaction costs bring the return down of the portfolio. If you rebalance too infrequently, your tracking error will go up and the return from your benchmark return will also deviate a lot. That can be good or bad depending on what kind of market you're in, obviously. So this study focuses on analyzing SDCERS rebalancing model to see, number one, do we have the best model? And number two, are there any changes or tweaks that we can make to make it even better? Allianz came up with 5 different methods to rebalance the portfolio. Now, the buy and hold is not really a rebalancing model, so I'm not going to go through that because that's basically just buying and holding your assets and not caring about if they go up or down in value. So the first one is rebalancing back to the edge. So that would be if you have a equity allocation of 24% or 21% and your upper band is 24 and your lower band is 18, then when you get to 24, that's the edge. So you would have to go over that edge for that rebalancing model to make sense. And that could make sense if you rebalance monthly or quarterly, or you look at the rebalancing model annually maybe. But SDCERS look at the rebalancing model twice a week. So we would never really exceed the band by more than, I'm not sure, but maybe a 0.01% or something like that. So a rebalance to the edge doesn't really create a rebalancing to start with, if that makes sense. The second one is rebalancing to the midpoint. So that would mean that if you have the band of 24 to 18 and your allocation is 21, you would, and you hit 24, you would take it down to 22.5. So you would rebalance between the edge and the strategic allocation. That has the benefit of not having as high of a tracking error as rebalancing to the edge, but it also increases transaction costs more than rebalancing to the edge because you rebalance more frequently, obviously. Does that make sense to everyone? Okay. The third one is rebalancing back to the IPS. So that's taking it back to the 21% that I was talking about. If you get to the 24, that triggers the rebalance, and then you take it back to 21. That reduces tracking error more, but it also brings the transaction costs up a lot more than if you did rebalance to the midpoint. And by the way, SDCERS policy right now is to rebalance back to the midpoint, so everyone knows that. The fourth and fifth rebalancing model is rebalancing back to relative bands. So instead of having, let's say, the 24 and the 18 bands, which is plus minus 3% of a 21% strategic allocation, you would have a 20% band of that. So 20% of 21% plus minus, or in the rebalancing 10% band, you would have a 10% deviation from that. Those bands create a lot of transaction cost because when you're looking at those bands, there's a lot of rebalancing action going on in private assets. And private assets have a lot higher transaction cost because of the liquid nature within those asset classes, if that makes sense. So let's see here. 21. So the kind of comparing transaction cost and tracking error, the results of the study, it identified, or as you said, Allianz identified this SDCERS current rebalancing policy as having a good trade-off between transaction cost and tracking error, and Aon and staff support those conclusions, and our recommendation is to maintain the rebalancing model with its current policy of rebalancing back to the midpoint, which kind of strikes that good balance between not too high of a transaction cost, but not too high of a tracking error, but it's in the midpoint between the two extremes. So with that, I'd be happy to answer any questions if there are any.
Questions? Over your head. No.
Yep.
Val?
Does the rebalancing policy, is the selection of a rebalancing policy ever influenced by what kind of market we're in? Or is it necessary to always have the same rebalancing policy in bull markets and bear markets?
It's important to have the same rebalancing model policy, and regardless of the market, because you don't want to be influenced by if you have a trending market like we've had in the last 2 years, rebalancing will go against you because you're selling assets that have gone up a lot and they've kept going up a lot.
Keep
So you're
going,
losing out on that.
Opportunity cost.
Exactly, but at the same time, then you would be guessing what the market is doing, and
Timing
we're
the
not in the
market.
business of guessing.
Even at this small, incremental, marginal policy level, you don't time the market.
Exactly. That's
This
exactly
gets
right.
back to the word discipline that you mentioned earlier.
And maybe something to mention too is, so when we rebalance, there are only two things that make a rebalance happen at SDCERS. It's either we hit the bands, or as what happened recently, we rebalance to fund benefits. So if we run low on cash, then we have to rebalance. It doesn't necessarily trigger a rebalance because we hit a lower upper band. It's just because we need cash, so we have to rebalance, and then that could be one.
Okay, Corinna's in the queue.
Yes, but I think Anders just answered my question. It was about do you use, obviously, the liquidity needs as an opportunity to rebalance?
Yeah, so we
then you're
use-
only rebalancing when you are exceeding the limit as set here in the IPS. You're not otherwise. When you look at the portfolio allocation twice a week, you're just checking that it's within those bands, but you're not rebalancing back unless you're hitting the trigger.
Correct. And then at the same time, when we look at the rebalancing model, we also look at cash levels to make sure we have enough cash in the predictable future to pay benefits. So that's one of the important things about the rebalancing model too.
Okay, if there's no further questions or comments, I think we're ready to vote. This did pass in committee 5-0. Motion.
Ready to vote? All votes are in.
And that passes 13-0. And thank you, Anders, for your presentation. And now you're going to move on to number 3, which is review and recommendation regarding SDCERS manager monitoring policy.
Correct. Thank you. So SDCERS Manager Monitoring Report is a tool that staff uses to identify managers that have gone through changes to their core business, potentially affecting the mandate that SDCERS has hired them to manage for us. This review kind of focused on looking at best practices across the industry and getting input from the general consultant, Aon. So as you can see in the red line version in your materials, in addition to shoring up some of the language in the manager monitoring policy, we've also made 2 changes. The first one is we've added a risk parameter to the manager monitoring report, and we've also revised the performance parameter in the report to be more flexible. This goes back, the performance parameter, the change there came from the use of peer rankings that we use now. We use 3- and 5-year peer rankings, and if you're in the bottom half, then you automatically go on the manager monitoring report. So that's not really fair sometimes to some of the managers where staff and consultant have imposed constraints. An example with PIMCO and TCW that have been on the manager monitoring report for years now, because we constrain them from using high yield bonds, emerging market debt bonds. We also have a minimum credit constraint. So when other managers don't have those constraints and we're in a really upward market where high yield and lower credit quality bonds do well, that penalizes them and doesn't really reflect the true nature of what we have asked them to do. So, and another example would be Stone Harbor, which is an emerging market debt manager that we use that has a blended mandate where they manage both local denominated bonds and US dollar denominated bonds. So we compare them against a peer group that only manages US dollar denominated bonds. So depending on what does well, that manager is not going to look so well in the peer ranking. So what we're going to do instead is we're going to look at all the managers across the board that we have on an annual basis and over all time periods, and present that to the board at the end of each fiscal year, so that there's no lack of transparency, but kind of maybe more transparency, if you would, because we're looking at all managers to make sure that they're doing what they're supposed to be doing and reporting out to you in a separate report, instead of letting managers linger on the monitoring report when they really shouldn't be on there. Then the risk parameter we've added is going to be measuring the manager's standard deviation versus that of their benchmark standard deviation. And we're going to look for spikes in the manager's standard deviation to see what are the risks that they're taking relative to the benchmark. And if there's a spike, we need to figure out, are they suddenly increasing their risk in their portfolio because of some reason? Maybe they're underperforming and they want to catch up or something like that. So, and with that, I'd be happy to answer any questions if there are any.
Questions, comments? Nobody's in the queue. Thank you for your presentation. We can vote at this time. I will make the motion.
Ready to vote? All votes are in.
And that passed 13-0. Next, Liza has another action item, recommended changes to SDCERS investment policy statement.
Good morning. The investment policy statement is a high-level policy document that outlines, among other things, the investment goals and objectives of the plan, the specific asset allocation, the rebalancing policy that Anders just covered, and the roles and responsibilities of the board, the investment committee, investment staff, and external consultants, advisors, and vendors. And I'm just going to provide a brief summary of the key changes to the policy. We've added some clarifying language and cleaned up a few things, but the major changes to the policy are basically on page 6. So the first item is we eliminated a separate 1% dedicated emerging markets allocation, and we moved that into the non-U.S. allocation. That does not change our asset allocation. It just means all of the emerging market equity exposure is in the non-U.S. bucket. So that was the first recommendation. The second is to change the benchmarks for private equity. So the first benchmark is to be in the top 50th percentile of the Burgess database. And then the secondary benchmark for private equity is 67% of the Dow Jones U.S. Total Stock Market Index and 33% of the MSCI All Country World Index, plus a premium of 300 basis points. Another change to the benchmark is the benchmark for infrastructure, which is moving from CPI plus a premium of 300 basis points to CPI plus 500 basis points. And there's a lengthy memo in your materials that outlines the rationale for that. We got input from our advisors as well as the consultants on the appropriate benchmark for that.
And so, Liza, that reflects the level of risk that we're actually taking in those programs.
Exactly.
Because they're not, 300 might have been appropriate for a core program, but we're doing more of a value-add opportunistic
Exactly.
program. Right, okay.
And then the last major change, which was outlined in the manager structure review, and we had a lot of discussion on this yesterday, was to change the mix in the portfolio between U.S. and non-U.S. to make it more of an even balance between U.S. allocations and non-U.S., which would compare to the opportunity set out there. And so the recommendation there is to move the U.S. equity allocation from 21% to 18%, and then the global allocation moves from 5% to 8%. And that gives us a mix U.S. to non-U.S. of about 53% U.S. and 47% non-U.S. And that compares to the global market opportunity set of 52 and 48%. And those were the major changes.
Any questions or comments? Oh, Almas?
Just curious what proportion of our assets are actively versus passively managed.
I believe on a total fund portfolio, about 30% is passively managed. If you look at U.S. equities, it's about between 50 and 60% is passive, and in fixed income, it's about a third is passive.
Okay, I can make a motion at this time if there are no further comments.
Ready to vote? All votes are in.
And that passed 13-0. Thanks, Liza. And I hope you all have an opportunity, if not right now, at some point to really study the IPS and look at it very carefully. It's an important governing document for us in our investment program. It outlines roles and responsibilities of everybody, including ourselves. So I think it's a good thing to be familiar with.
Could I ask if maybe Liza or Greg could circulate a cleaned up version of the updated policy to all board members? Just email it out.
We certainly will.
Yeah, that'd be great. Okay, continuing on the agenda, we had a no action requested item, analysis of private market fees compared to peers. This is something that Jamie prepared, I think, in response to questions from the board when we did some new reporting that's required by law last year on aggregate fees in private markets, private equity infrastructure, and real estate. We ask that you just look at that study, and you'll find that our fees she reached out to some peers, and our fees are really kind of in the middle, not too high, not too low, and so it was a helpful study, and we ask you to look at that offline. We're now moving to old business, the follow-on review and recommendation on manager structure and implementation. This was something that carried over from the last meeting. We ended up tabling this item after a robust discussion by the committee. We felt that there was some additional review and analysis that was needed to approve the recommendations, and we're hopefully going to be able to do that at the next meeting. And we have another no action requested update on DWS, which formerly known as that's the Deutsche Bank Real Estate Group. They just keep changing their name. Separate account transition. As you know, we've been in about a 2-year process of selling our portfolio of sort of large, lumpy real estate assets and redeploying that into core open-end funds. The process is going very well. We're realizing values, I believe the number was about 10% above carrying values on those sales in aggregate. So we're locking in some profits at I think a strong time in the market. But we encourage you all to also look at that analysis if you'd like. We're now going to move to status reports. Very briefly, Jamie's going to cover the 2 private equity managers and the real estate portfolio.
I think pictures are more helpful when you're looking at
Good.
performance.
Did you have
A
Ted
quick
do that?
note before I
Did Ted do that for you?
No, he didn't.
Oh.
A quick note before I jump into the performance. You'll notice that the format of the performance presentations for both GCM Grosvenor and Stepstone look a little different. We've tried to enhance the presentations that are in front of you to provide you with additional information that hopefully is helpful. So looking first here at GCM Grosvenor's performance, the combined net IRR for the GCM Grosvenor Pacific Fund on a since inception basis is 16.2%. Breaking that down further, private equity had a since inception net IRR of 17.4% and outperformed both of the benchmarks, the peer benchmark, which is the top 50th percentile of the Burgess Private IQ database, and then the public benchmark, which was at 14.8%, which is the 67% to the Dow Jones U.S. Total Stock Market Index, 33% to the MSCI ACWI ex-US, plus 300 basis points. Yes, that is a mouthful to say. Looking over at infrastructure, also had a strong return of 11.5% for a net IRR since inception basis, compared to its benchmark of CPI plus 3%, which was at 4.8%. Just a quick note, that is still reflecting the old benchmark that will be implemented in the next performance report.
So it's going to be CPI plus
500, yes.
Right.
Thank you. So that concludes my remarks about GCM Grosvenor. If you have any questions, I'd be happy to answer them at this time.
No question.
Okay, moving on to Stepstone. So as I mentioned, similar format in the performance report. So just going to summarize the performance for you. The combined since inception net IRR for the Stepstone Atlantic Fund was 14.4% as of the end of September 2017. Breaking that down further, private equity had a since inception net IRR of 16.2% and outperformed both of the benchmarks, the public benchmark at 14.3 and the peer benchmark at 9.3. Moving over to infrastructure, infrastructure had a since inception net IRR of 7.3% versus the benchmark at 4.7%. And if you have any questions, I'd be happy to answer them. Great.
No questions? So we can move to real estate.
And finally, real estate.
Slides. We didn't have a slide for Stepstone, so.
Oh, sorry. Could you put it back in the?
Yes, sir.
Yeah, we can move on, but
Yeah,
hopefully we have something
sorry.
for real estate.
I didn't realize. Sorry about that.
That's right.
Everyone here. Oh, there's the slide that goes with it. Sorry about
Your
that.
Stepstone and,
So for real estate, this summarizes the performance as of the end of September 2017 as well. The performance of the real estate portfolio looks strong on a relative and absolute basis. For the quarter, SDCERS had a return of 2.4% versus the benchmark at 1.8, so it's 60 basis points of outperformance. Looking over at the year, SDCERS had a return of 9.2% versus the benchmark at 6.7%, which is outperformance of 250 basis points. The rest of the time periods, SDCERS continues to outperform with the exception of the 10-year period, which has some slightly below the benchmark. What's important to note here, you'll recall as Carol just summarized in the update on the DWS transition, we are in the midst of liquidating that portfolio. We think that this is a great time in the market, and that is certainly contributing positively to the performance of the portfolio. In addition to that, our opportunistic portfolio, which has most of its return driven from appreciation, we're now starting to see that appreciation. We think we're officially out of the J curve, and now we're starting to reap the benefits of that portfolio. With that, I'd be happy to answer any questions that you have.
Questions? No questions?
Great. I have one quick
yes.
one,
Go ahead.
actually. So I noticed it's through September 30th. When do the December 31st numbers
It'll be
become
at the
available?
next meeting. They're just finishing up the data right now. It was slightly delayed this time around because of the update in the private markets performance reports. We wanted to make sure that those were really tied down before we presented them, and we didn't want to present real estate without private equity and infrastructure.
Okay.
Thanks, Jamie. Just a final note, as you can see, the returns from the private asset portfolios are very strong on an absolute and benchmark relative basis. And that, we look at a time when theoretically we might have lower public market returns, although that really hasn't been the case. We look to these asset classes to provide some enhanced return, and they seem to be delivering very nicely.
Could I ask a question?
Yes, Val has a question.
We're talking about returns, but when we talk about returns, maybe we could just address risk real quick. I always assume that if we're getting these spectacular returns, we're taking more risk to get those returns. And philosophically, maybe that's not true, and I'd like to hear, on a risk-adjusted basis, what do we think about this? Because philosophically, one of the issues that this board addresses when it sets the discount rate is how much risk should we be taking? Because when we set a discount rate that is 6.5% versus 7% versus 6%, we're in essence determining how much risk you in our investment side need to take in order to achieve the return that we've pegged. And I worry about even a 6.5% return because historically pension boards and pension funds were highly risk averse. And the way we're achieving these fabulous returns is by allocating to things like private equity and real estate that historically, real estate may have, but private equity did not make up a significant part of a pension fund's portfolio. So from a philosophical point of view, I'd like some discussion of the risk associated with these fantastic returns that you folks have achieved.
Well, I think I can comment a little bit on that. Obviously, in private markets, there is a higher level of risk, but not necessarily all that much higher than equities. If you look at the portfolio, the largest risk in the portfolio is equity risk. So it's not necessarily higher risk in private markets. That being said, some of the great returns we've seen in real estate are just from this market cycle. We've actually restructured the real estate portfolio to be more focused on the core, more conservative part of the real estate market compared to where we were when I started about 10 years ago, where it was much more value add, aggressive posturing there. So that we've really scaled back some of the risk in the real estate market. I think the returns are just a function of this cycle in the real estate market. Now, on the other side, in private equity, yes, we have a more aggressive posture there. And we have great returns, although part of those returns really stem from the fact that we started that program at just an incredible time. In 2009, and that was just really a fluke of the timing, that was the bottom of the market. We were buying assets and secondaries at huge discounts, 25, 30%. So that accounted for a lot of the great performance. And really, the other half of it was because we positioned the portfolio to be very opportunistic. And one of the key goals that we wanted to avoid was the J curve, where you invest here and then the early years you're not getting any return, so you're actually losing money and then you start earning money in the later years. Well, we wanted to avoid that if possible. And that's how we structured the portfolio. We bought a lot of secondaries, which were immediately throwing off cash, co-investments, which had much shorter time frames in terms of realizing those cash flows. So we never had a J curve. So it was a very opportunistic approach to the market, and I think that's helped generate the strong returns as well.
Thank you, Liza. And I guess what that brings to my mind is the importance of recognizing that we've had some good fortune and some very good management that we can't expect to always continue. Things revert to the mean.
Right.
And so we on the board need to be very mindful of the fact that while we've got this great stuff happening, this is not, we can't expect this to continue into the future. And we need to bear that in mind when we make policy decisions and do planning. And I'm sure our staff does when they approach things in such a disciplined fashion.
And I just add on to that, when Aon Hewitt goes through their capital markets assumptions, so expected returns for different asset classes, it's not anything compared to what we've seen recently. I mean, the long-term expected return for real estate would probably be somewhere around 7 to 8%. Private markets may be in the low teens.
Right, and I fully expect when we are done with the process of selling these individual assets and we redeploy into core funds, and given kind of where market conditions are, core funds are going to generate something in the six-ish range, probably right around our discount rate, and we're going to be looking to the opportunistic part of the portfolio to add, that little bump over that level. But you're absolutely right; these aren't sustainable. But another point I would make about all these portfolios is that they're very, very diverse. So you don't have any really concentrated deal risk. That's what we're accomplishing by selling these individual real estate assets. And the private equity portfolios are, $400 or $500 million portfolios, and they're doing individual investments that are like $2 to $10 million. So there's many, many, many positions, which I think helps
Diversifies.
Helps diversify.
And the other thing that we are currently doing within each of the portfolios within private equity infrastructure and real estate is we're trying to position each of those portfolios to have a little bit of a defensive posture. We know that winter is coming. We want to ensure that we are taken care of so that we are, so that the portfolios are protected. And I believe George was,
Yeah,
sorry.
I'd just like to say, obviously, we should focus on the performance of each of the types of sectors that are in our portfolio, whether they're private equity, real estate, stocks, or bonds. But what we really need to worry about is the portfolio overall going to produce what we need, both in terms of risk and return? And to some extent, you can say, well, real estate has done well. Maybe it's going to get, it's going to turn around. So be it. But we need that diversity, as Carol says. And without that diversity, you have a much higher portfolio risk. And so it's kind of like, well, you don't want to take your medicine because it tastes bad, but cod liver oil is good for you, and so you take it, and maybe you don't like real estate looking forward, but we need that diversity because trying to predict performance is extremely difficult and beyond what we've decided as a group to try to do. I mean, we don't try to predict portfolio, we don't try to predict future performance that much.
Right, thank you. Yeah, absolutely right. Tanasi's in the queue.
So I guess just a general question that I have, and I don't know that I need an answer today, but I think what I'm trying to understand is that when we're setting policy for, if we're doing it for the entire portfolio, when we set that discount rate, and I guess what I don't know that we spend enough time talking about is whether or not the investment team thinks that we are properly positioned to hit those numbers specifically. And I don't know if I necessarily need a comment today, although if you have something, it'd be great. I'm just trying to, and the other reason I'm concerned about it is when you look at these numbers and you say, oh, we're doing great, but really the portion of the portfolio we're talking about is a relatively small piece of that portfolio. And so it's difficult sometimes for simple-minded people like myself to stop and think, okay, well, what's that total return, and are we really poised to hit that? Because if we're not, or if alternatively, the other thing I'd like to know is what's driving you guys? Are you trying to hit that number, or are you trying to create an appropriate risk-adjusted return, and then how is that delta communicated to us, or how is that process communicated to the board?
Well, that comes to the board in the form of the annual asset allocation review, where Ann came in here and talked about their capital markets assumptions, which are expected returns for different asset classes. And then based on our overall allocation, what we can expect to earn on the portfolio. It's currently about 6.5%. What the investment team is trying to do is working with Aon to put together a well-diversified portfolio, so achieving a good return and trying to minimize risk so that we have enough assets to pay the liabilities. That's the long-term goal of the investment program. We're going to talk about that in depth because we're coming up probably later this year. We're going to talk through an asset liability study, which is going to lay out what are the assets we have, what's the projected growth, what are the liabilities or pensions that we have to pay, and what's the appropriate risk posture that we should have in the portfolio. And we're going to actually have 2 sessions on that. One's going to be an educational session, just explaining, walking everyone through what an asset liability study looks at. We've also asked Ann Hewitt to do a 10-year cash flow modeling, because we're in a negative cash flow situation, to see what that looks like, and if we need to change the allocation, especially to the illiquid portion, which is the private markets, because you can't readily sell those assets. So that's going to be the first piece, and then the second piece will actually be walking the board through that study and that process.
So what I think I heard, just so I'm clear on that, is that at the moment, you guys are expecting a return of about what we need, and you're closely monitoring that.
Correct.
Okay, so I guess just the takeaway for me is, if we don't hit those targets for any reason, because if we're saying we're expecting to hit it, essentially right on, there isn't that if we don't hit it, we potentially have an interesting issue here. And I understand that there's a long-term horizon, but I'm just saying we're currently pegged to meet our expectations. Is that correct?
I believe so, okay. Yes.
All right. Thank you.
Bill's in the queue.
That's a good question, Tanasi.
Every once in a while I get one.
The way I kind of look at it, big picture-wise, is over the last 7, 8 years, we've been de-risking the portfolio. So we're moving more from active to passive, like 50-50 now. And in the real estate portfolio, we're getting out of the separate accounts, moving them into large institutional funds, and we're willing to de-risk and take a little less return in order to give us the stability and liquidity that we're going to need. Coming in the future years, we're going to need more liquidity. So we have to be prepared for that. Now, if you look at the last 10 years, our average return's been about 5.7. something in that neighborhood. So it's below the 6.5. We've had this 10-year run-up of equities and whatever, and it's been incredible. But we can't expect that the next 10 years. I think, we're going to be moving, for instance, in the real estate side of the portfolio of what have been double-digit returns into single-digit returns into like 6% returns or 7% returns, somewhere in that neighborhood. That's right around what our target is. That's just my comment on it.
I would just like to add to that because I was just recently at a conference and was talking to a number of my fellow CIOs, and one of the concerns is the 10-year number right now looks low because it includes the drawdowns from the last financial crisis of 2008 and 2009. Relatively soon, that old history is going to roll off, and the 10-year number is going to start looking a whole lot better. And the concern among CIOs is that they don't want to forget about what happened in the 2008-2009 picture because suddenly the 10-year number looks a whole lot better. That we all have to be cognizant, as Jamie said, winter's coming, although not really in San Diego, but and that we want to be prepared for that next downturn and not get carried away saying, oh, all the long-term returns look good now.
We're going to have a lot more discussion of this as we move forward through this year. And all of it really relates to not only the issues of our investment policy and our allocations, but to our discount rate and where we set it. And I know I think we're all really proud of what this board did last time in lowering it the way that we did ahead of the curve. Others are doing it now as we did a year ago. But we always have to keep our eye on that, and this is really important stuff to talk about. I think we've probably reached the end of what we can do today, but we're going to be talking about this for the next 6 months and then recurrently after that. So.
And can I just add one last thing? Sorry. At this conference, we had the lowest discount rate of any other plans that were there, and everybody was very impressed by that.
Thank you. All right.
Okay, that concludes the investment committee, and I want to thank the staff for all the great work that went into the presentations and analysis.
All right. Thank you very much, Carol, Bill, and the rest of the, George and the rest of the committee, Karina. Really appreciate, and Tom. Thank you, guys. It is a really great job that you guys do, and of everyone on this board, you guys work the hardest, and we know that. So it's appreciated. That brings us, I think, to training and Johnny Tran.
Oh, pardon me. Liza, were you going to make the comment about the SEC again? We had one additional comment that was at the meeting. I apologize.
So this is just an informational item, but SDCERS has been asked by CalPERS and Ontario Teachers Pension Plans to co-sign a comment letter to the SEC supporting their proposal for a transaction fee pilot study to test the impact of the elimination of rebates in the U.S. equity market. For the past several years, a number of asset owners and asset managers have urged the SEC to look at the exchange rebates and the potential conflict of interest that it introduces to the broker order routing process. The way the current market is set up and that they're proposing to review is that exchanges pay rebates to brokers for order flow. And these pricing schemes create a potential conflict of interest between brokers and their investor clients. What the study proposes to look at is what happens if you take away the rebates? And what impact does that have on order routing and, most importantly, on execution quality? Because brokers are currently incentivized to route an order to the venue that pays it the most instead of to the venue that has the highest likelihood of offering best execution. So the SEC pilot is now in a 60-day comment period, and we believe that it's critical for the pension community to support this effort and have this study ongoing. And that's it.
That sounds, I mean, I for one concur with what you're saying, and that sounds like a very worthwhile thing for us to support.
Yeah. This was brought to our attention by one of our investment managers, Brandis. And we met with their head trader, who had noticed over the last number of years that when he was going to place an order in the market and he sees what the bid is or the offer, whether they're buying or selling, and he's thinking, I can trade at that price, and then consistently is not getting that price, is getting a worse price.
Is there litigation being considered, or is it
No,
merely
this is way too early
regulatory?
for that. They just want to see, basically, what happens if you take away these incentives for brokers to go to these various exchanges instead of an exchange where they can get better execution.
Do those brokers, are there fiduciary duties running from those brokers, or are there not? I think there's some, I mean,
I don't know. I don't know. Our managers have a fiduciary duty to us, but they have to trade through brokers,
right.
and I don't know.
Thank you, Liza.
So I just had a comment on it. I thought about this overnight because Liza explained to me kind of what was happening here. And I know there's been the flash trading going on and that sort of thing. But I'm basically a free market guy and like less regulation generally. So I think the study is a good idea because I think it should point out whether there's some irregularities going on with these trades. But in general, I'm pretty much against interfering with the free market. So it's just a thought. You know, when it was brought up yesterday, it was new to me right away, so I had to think about it a little, and that was my thinking on it.
And I think we would agree that we want a free market. We just want an even playing field. Tanasi?
Yeah, I have some limited experience just because I've done some litigation and some representation of clients in front of the SEC on this, but my understanding of those rebates, and it could be very wrong, is that the rebates are provided to ensure that there is a market available to execute on trades. In other words, the process is we don't want trades pending that can't be fulfilled. And so these rebates essentially are there to ensure that someone's going to make the market. And at least that's been with the clients that I've dealt with. And so, and these rebates, by the way, we're talking about fractional pennies of, I mean, just out to zero. But the issue is that, so what I'm concerned about is I'm fine with the study, although I am concerned because it seems to be that these rebates are essentially just a cost of maintaining the market, and everybody's paying it, meaning it's not just SDCERS or somebody else trading, it's sort of the cost of allowing that market to exist, and everybody's paying these fractional fees to these market makers. So I mention that not because I think it should sway our decision, but sometimes when we present these questions, it comes out automatically as there's something villainous or underhanded going on, and I don't know, that certainly wasn't the intention of how it was created in the first place. And so I just want to offer that to my fellow committee members to say, just be aware that that these things were initially created at least as a good thing initially. Whether that's still a good thing, whether there's a problem, different issue.
Right.
What I'm hearing, though, is the potential that there is a market inefficiency or a perversion of the market that's being created by the structure that is leading to less efficient outcomes for the consumer of the service.
Right.
And if that's if the study turns out to show that to be the case, then I don't think it's interfering with the free market at all to make changes to what is, frankly, an artificial structure in the first place in order to eliminate what may be an anachronistic system that is now creating market inefficiency and adding an unnecessary cost that may be hidden from people in a sense, or so small on a per transaction basis that no one cares, but on a macro basis is very important.
Yeah. Well said. Thank you.
Oh,
That's for the use of the word anachronistic. Thank you.
Okay, thanks, Liza.
Anachronistic is the word. I screwed it up. Sorry.
It's okay. I paid my share of it, though. Okay. That's what I mean.
All right. So we've reached the point where we get to training, but I think if we adjourn now for 5 or 10 minutes, then we can finish our meeting and go straight into closed session. I was going to try and do the rush to closed session, but I think we should stop. So let's take 10 minutes, come back at 5 minutes until 11, or until 10. We're back after the break. It's a few minutes after 11. Are we back on the record here?
Yes.
All right. A few minutes after 10. I'm sorry. This meeting has actually been going pretty quickly. All right, so we're now on to the training part of the agenda, and I would ask Mr. Tran to report.
Thanks, Val. We have a few requests. I'd like you to vote on them as a group. They're on your monitors, but briefly, Mr. Kenny would like to attend an IFEBP conference in New Orleans. There's 2 programs that he'd like to attend, October 13th to the 14th, then stay around for another one, 14th through the 17th. Carol Broad would like to attend the PIMCO conference in Newport Beach on June 11th. With that, I'll need a motion and a second.
All right, the motion's been made and seconded.
Ready to vote?
Is there anybody who hasn't voted?
Tom? I clicked it. Okay, all votes are in.
Great. Passes. Are we still 13? Nope, we're 12. 12 with an abstention. All right, thank you. Anything else, John?
No, thank you.
All righty. Brings us to questions and comments from presidents, trustees, and staff.
Val, I did want to make one comment about our discussion about Proposition B. So as you know, the California Supreme Court agreed to hear the Public Employees Retirement Board's challenge to the Court of Appeals ruling concerning Proposition B in the city of San Diego. So oral argument is set for May 29th. Obviously, the outcome of that decision could affect SDCERS as we administer the city's benefit. But we are not a party to that lawsuit, and in fairness, as the administrator, we haven't taken a side on that. I just wanted to mention that, and I know that Greg forwarded a few good articles to you recently about that. Any questions about that?
It looks like Charlie Hogquist is in the queue.
Yes, I just wanted to thank staff on behalf of the Retired Employees Association. They wanted me to express their gratitude for helping them do the informational mailer and give you guys a pat on the back for what you did. So thank you on behalf of the REA.
Thank you. Almas.
Thank you. I missed a couple votes at the beginning of the meeting. I apologize for that. I would have wanted to register a yes vote. I reviewed all the materials. I don't know if that's possible, but I would like Johnny to at least research it and see if that would be possible for me to register yes votes on those items.
Only because they're yes votes, I would agree to that if it's okay.
The votes were unanimous, and they will remain unanimous, but let's see if we can get Almas's vote counted. Great. Great. Any other questions or comments?
If I may?
Yes, please.
I just wanted to do a couple recognitions. One, I wanted to recognize our Chief Investment Officer, but Liza is not here, but she was named by Trusted Insight, a trade organization for education, on the 2018 Top 30 Public Pension Fund Chief Investment Officers.
Wow.
So that was a very nice recognition, so I recognize Liza for that.
So are you saying she didn't make the top 10? No.
She may have. We just don't know. We'd also like to recognize some legal office team members. They were recognized and thanked by the San Diego City Clerk in all of their help for putting forth the statements of economic interest filing. So it was nice to see a letter of accommodation signed by Elizabeth Milan, the city clerk, for Melanie Peters and Jessica Maloney. Thank you very much for your help and support. And also from our legal team, I wanted to recognize Susan Youngflesh for graduating the City Management Academy class. I had the pleasure of going to the finalist presentations where her group talked about cybersecurity, and Susan did a wonderful job. It was probably the longest segment of her team talking about cybersecurity here at SDCERS and all the strengths of our robust security program. So thank you, Susan. Also at SDCERS, we have a robust wellness program where we encourage wellness for all of our employees. And as part of that, we also get involved in fundraisers around the community. And I also wanted to bring the board into the fold in that we are having a event fundraiser, Relay for Life, which is teamed up with the American Cancer Society, supporting cancer patients and survivors and caregivers up at Lake Poway on May 19th and 20th. So if you would like to become involved in a good cause, please see Luli, our HR director, and she'll give you lots of information on that. Also, I wanted to highlight that for the retiree healthcare program, our open enrollment is coming up. And it begins, I believe, June 4th, and we will be holding an event for the retirees to come to Balboa Park on May 30th to meet with all the insurance carriers and get information with regards to the carriers, what's happening in the program. And I thought was really great ideas. They're also bringing in some Medicare experts to answer questions. So just wanted to give a shout out for that. And finally, in our boardroom, we are getting a lighting upgrade. And so we believe that will happen between now and our next board meeting. And so as you come next month, I think the lighting will be a bit brighter. And so we would, after we put in the lights, we believe that they will be helpful, not hurtful, but we will definitely be seeking the board input on the new lighting.
Is there a
Do I
makeup
also
artist for
understand
us?
that there will be a makeup artist seated outside the door? Yeah, we're all on that.
What is really nice about this, and I would like to commend David Bond from our staff and his team, is that this was done with grant funds from City TV. So because we are, one of our foundations of our organization is transparency, and we broadcast our meetings, they want us to help support us in that, and so they're going to help us improve our broadcast capabilities with a grant.
Great.
And that wraps up my comments. Thank you.
Great. All right, so any non-docket items?
No.
No non-docket items. In that case, we will adjourn into closed session and report out afterward. And I've asked Marcel Rossman to stay for closed session as well.
So in closed session,
All right, we'll be back in session just for a minute so I can report out from closed session. At this point, I'd like to report out that we had a closed session meeting in which the board voted unanimously to authorize our legal staff to take appropriate action regarding the conflict over the death benefits of Ronald Wiggins, which may include but is not limited to the filing of an interpleader action with the funds. We ask only that the staff ensure that the pension fund is not put at risk and that all parties are treated fairly and transparently. So with that, I don't think I have to report anything else out of closed session. And so with that, the meeting is adjourned.